Okay, let's dive in. Imagine you're holding a document that acts like a key, unlocking exactly what trips up professionals in a complex field and really revealing what truly matters. That's what we're exploring today.
We are. We're taking a deep dive into the ACCA Audit and Assurance, the AA September-December 2024 Examiner's Report. And yeah, it's much more than just exam feedback. It's really a concentrated snapshot of common misunderstandings, areas where knowledge needs to be super precise, and the practical skills auditors absolutely must master.
And our mission with this deep dive is really to pull out those critical nuggets for you. Whether you're deep in audit, you interact with auditors, or maybe you're just fascinated by the rigor needed to verify complex information. This report gives you a shortcut to understanding the real challenges and the non-negotiables. I'm actually really keen to see what it highlights about applying theoretical knowledge in practice.
Well, examiner reports are just invaluable because they distill the experiences of thousands. They show where that theoretical understanding breaks down in application, where crucial details get missed, or maybe why certain standards have such absolute requirements. They really highlight the difference between knowing a rule and understanding its real-world impact.
Okay, so let's start with something fundamental that the report touches on across different areas. The surprising importance of seemingly small details, especially when it comes to auditor independence and professional conduct. The report pulls examples from the objective test questions, Section A, which, despite the format, require really precise knowledge.
They really do. Take, for instance, the point about late payment of audit fees. On the surface, it just sounds like an admin issue, but the report emphasizes this creates a self-interest threat for the auditor.
Ah, right. The auditor might be less likely to issue a critical report if they're worried about actually getting paid. That feels very human, doesn't it?
Exactly. And the safeguard the report points to isn't just chase the payment, it's specific, agreeing a revised payment date before the auditor's report is issued. That timing is absolutely crucial because the report is, it's the culmination of all the audit work.
Right, okay. And what are contingent fees? That's another area where the report noted issues,
Yes, specifically accepting contingent fees for non-assurance services, like maybe tax work, if those fees are material. The report really underscores that a fee structure dependent on the outcome can fundamentally impair independence, especially when the auditor is also providing the assurance services. It's another example of how financial arrangements can create these potential conflicts.
Okay. And independence threats popped up in a few places, right? Like familiarity threat, the example of a former audit team member becoming the client's finance director.
That's a classic one. That close prior relationship. It can make objective professional skepticism really difficult. The report also flags self-interest threats in maybe less obvious areas, not just direct financial stakes like shares, but even things like free activities offered to the audit team by the client. It just shows how broad the definition of potential influence can be.
Okay, so here's a point from the report that uses very strong language. It talks about advocacy threat and says the audit engagement partner must decline requests to represent a client in discussions with lawyers. Must decline.
Yes, and the report uses the term unmanageable advocacy threat. That's the key word there. It means no safeguard, absolutely nothing, no matter how robust, can reduce that threat to an acceptable level. An auditor's job is to form an independent opinion, which needs impartiality. Representing a client in, say, a legal negotiation is actively championing their cause. It's the complete opposite of impartiality. So that word unmanageable, it really highlights that this action is just a red line. You simply cannot cross it and remain an auditor on that engagement.
And tied into that is the absolute nature of professional confidence or confidentiality. The report was crystal clear here.
Absolutely crystal clear. Auditors cannot disclose client information to journalists. Full stop. It's a non-negotiable breach of confidence.
So you can't even make a sort of judgment call like, well, this information isn't that sensitive, or maybe it's not material to the financial statements.
No, the report explicitly states that materiality is not a valid consideration for disclosure. The rule is incredibly strict. Disclosure is only permissible in very limited, specific circumstances, typically when you're legally or regulatorily required to, reporting money laundering suspicions. Why this absolute stance? Because the whole bedrock of the assurance profession is trust. Clients open up their most sensitive financial and operational details to auditors. That trust would just evaporate if confidentiality wasn't absolute, unless, of course, a higher legal duty mandated disclosure. There's really no room for auditor discretion based on, perceived importance.
That really highlights the ethical spine needed in this profession.
Wow. It's not just about the numbers, is it? It's about fundamental trust and integrity.
Precisely. That's the core of it.
Let's shift gears a bit then and look at what the report reveals about applying knowledge to real-world scenarios, particularly in the constructed response questions in Section B, which demand, well, deeper application. A common struggle identified was around understanding internal control.
Ah, yes. This came up under ISA 315, the standard for understanding the entity and assessing risks, which includes internal control. The report noted that many candidates just didn't provide enough detail on the 5 components of internal control.
Okay, the 5 components being, let me see, control environment, entity's risk assessment process, entity's process to monitor the system of internal control, information system and communication, and control activities. Got them. Right. And the report pointed out a specific misunderstanding there, that information system and communication is often too narrowly interpreted as just, IT systems. It clarifies this component is really about the records the entity uses to process transactions and account for assets and liabilities, which includes manual systems just as much as automated ones. Why is detailing these foundational? Well, because if you don't truly understand the system of internal control, you just can't effectively identify where risks of misstatement might exist. It's a bit like trying to diagnose a car problem without knowing how the engine parts actually fit together and interact.
That makes perfect sense. Yeah, you have to see the whole picture. Speaking of systems and where they break down, the report covered identifying control deficiencies and making recommendations. This feels like a core practical skill auditors need, right?
Oh, absolutely. It's bread and butter stuff. The report shows candidates sometimes just sort of rephrase the scenario information instead of really pinpointing the actual deficiency. And crucially, when explaining the implications, they often fail to clearly link each specific deficiency to an increased risk of fraud or error in a particular area of the financial statements. There needs to be a clear cause and effect explained for each point, not just general waffle.
Okay, so if the scenario says something like, bank reconciliations aren't performed regularly, the deficiency isn't just irregular bank recs. It's more like lack of regular independent bank reconciliations. And the implication isn't just could be errors. It's increases the risk that cash balances could be misstated, or maybe that fraud could go undetected for a longer period. Is that the idea?
Exactly that. The report really emphasizes that precise linking. And the recommendations need the same level of precision. They must be detailed, actionable suggestions that directly fix the identified deficiency. Not just vague advice, but practical steps management can actually take.
Right. Like for that bank reconciliation example, the recommendation wouldn't just be management should improve bank reconciliations, but something much more concrete, like management should implement a policy requiring monthly bank reconciliations to be performed by an employee independent of cash handling and recording, and then reviewed by a supervisor.
Much better. Much more useful and direct. This level of practical detail is a key finding across the report, really. The report also highlighted struggles with substantive procedures, using revenue as a key example.
Okay, what were the common pitfalls there then?
Again, often a lack of detail. Substantive procedures, remember, test the monetary balances directly. So the description needs to be specific. What exactly are you doing? Which document are you using? And why are you doing it? What assertion are you testing? A frequent issue, the report noted, is mixing these up with tests of control.
Testing the system's effectiveness versus testing the actual numbers themselves.
Exactly. And for revenue specifically, the report noted that candidates sometimes focused on procedures for trade receivables, which is a balance sheet item, instead of procedures directly testing the revenue balance in the profit or loss account. Analytical procedures are highlighted as particularly useful for revenue, by the way. And cutoff tests. They require specifying the actual test, like examining goods, dispatch notes, GDNs just before and just after the year end, and then agreeing them to sales invoices to make sure revenue is recorded in the correct period. It's all about checking the timing is right.
Got it. Okay, shifting slightly again to corporate governance. What did the report reveal about common issues there?
Well, it's a similar theme, really, needing clear explanation and actionable recommendations. Candidates needed to properly articulate how a corporate governance weakness actually arose from the scenario facts, not just vaguely state there was an issue. And the recommendations, just like those for internal control, needed to be specific and directly address the problem identified. The report gave the example that if the CEO is also the chair, the recommendation isn't just don't appoint the CEO as chair. That's too simplistic. It should be suggesting the appointment of a new independent chair to provide stronger oversight and that crucial separation of roles.
That level of specificity seems absolutely crucial across the board then, from deficiencies to recommendations. Okay, finally, the report looked at audit planning and identifying audit risks, referencing the Mizotaztic Co. scenario.
Yes, it did. It covered the benefits of audit planning again, needing, say, 4 well-explained points, focusing on the practical benefits, like directing audit effort efficiently or assisting in team allocation rather than just generic statements. And for identifying risks, the report stressed reading the entire scenario really carefully. Don't just skim.
And linking the risk clearly back to the financial statements.
Absolutely. When you state a risk, you must name the specific financial statement area that's impacted. Is it property, plant, and equipment? Inventory? Revenue? Then link it to an assertion like valuation, existence, completeness, and indicate, if you can, from the scenario, whether the balance is likely over or understated. Just saying assets are wrong is far too vague.
Yeah.
It needs to be something like property, plant, and equipment is potentially overstated due to the incorrect capitalization of repair costs. Much clearer.
That level of precision, again, it keeps coming up. And the report noted a helpful kind of rule of thumb about identifying risks.
Yes, a sort of general guide is that often one key piece of information or a significant event mentioned in the scenario corresponds to one identifiable audit risk. It's a useful way to try and make sure you've picked up on the critical points. And underlying all of this risk identification, you absolutely need a solid understanding of the relevant financial accounting standards. You have to know how something should be accounted for to spot the risk that it isn't.
So pulling all of this together then, the absolute rules we saw in Section A, the detailed application issues in Section B, this constant need for precision, linking cause and effect, actionable recommendations. What's the overarching takeaway from this deep dive into the examiner's report?
Well, I think it's clear that success in audit, and probably in many analytical fields, isn't just about knowing the rules off by heart. It's really about understanding the why behind them, recognizing how those theoretical concepts actually apply to messy real-world situations, possessing a really sharp eye for detail, and being able to translate observations into concrete steps, whether that's formulating a precise audit procedure or suggesting a practical improvement to a company's processes. It's fundamentally about connecting the dots between a seemingly small detail and its potential large consequence.
And for anyone listening, regardless of their field, what can we take away from this rigorous world of audit? What's the broader lesson?
I think it really highlights the value of applying a similar level of critical thinking to any system or process you encounter in your own work or life. Can you identify potential vulnerabilities? Can you understand the likely knock-on effects if something goes wrong? Can you suggest specific, actionable ways to make it more robust or reliable? This deep dive into audit methodology really gives us a framework for thinking about accuracy and trust in information and systems much more broadly.
Yeah, it's about seeing the world with that kind of detail-oriented, risk-aware perspective. And yes, as the report implicitly suggests, actually practicing applying this knowledge is how you really embed it.
Absolutely. Practice is key.
Okay, well, this deep dive into an examiner's report really shows just how much skill and detailed knowledge goes into ensuring financial information is reliable. It definitely makes you think, how could applying this level of rigorous, detail-oriented analysis, looking for the specific deficiency and its clear implication, how could that help us understand and improve the systems or processes we encounter every day, no matter what field we're in?
It's a really valuable lens to apply, I think.
Definitely something to reflect on.